Welcome to this explainer. We're diving straight in today to build your professional trading armor. Let's be real, if you're tuning in, you probably already know your way around a chart. You know support from resistance, you can spot a trend, but consistency still feels just out of reach, right? Well, today we are fixing that. We're going to break down exactly why we fail despite all that knowledge, and we'll build a rock-solid professional checklist to finally eliminate those self-inflicted wounds. So get this. Did you know that a simple pre-flight checklist actually reduced aviation crash rates by over 90%? It wasn't better engines or some fancy new training protocol. Literally just a pen and a piece of paper. Think about it. In trading, we are just biological organisms trying to operate with machine-level consistency. But we're doing it in an environment completely designed to overwhelm our cognitive capacity. The market throws endless variables at us in real time, and honestly, human beings are catastrophically unreliable at handling complex tasks under that kind of pressure. Which brings us to a really fascinating concept. We don't fail in trading because we're ignorant. We fail because of ineptitude. Ignorance is when you just don't know the rules of the game. But ineptitude, that is failing to apply what you already know in the heat of the moment. It's when your amygdala, the emotional center of your brain, completely hijacks your rational thought process under pressure. You absolutely know you shouldn't take that trade, but the FOMO hits and bam, you click buy anyway. That right there is ineptitude. And a system is your only proven defense. So our explainer today will follow a strict 4-phase life cycle to forge your checklist: the pre-market audit, technical entry criteria, risk management rules, and the post-trade review. Let's kick things off with phase 1, the pre-market physical and mental audit. Listen, a professional trade starts way before you ever pull up a chart, and it begins with the absolute most important factor, you. So many traders skip this. They just assume their brain is firing on all cylinders 24/7. But biology plays a massive role here. Ask yourself right now, did you eat well? Did you get enough sleep? Are you actually in a good mood? These aren't just fluffy self-care questions. If you got 2 hours of sleep or had a flat tire this morning, your emotional fuse is incredibly short. And that short fuse will absolutely destroy your discipline right when you need it most, like when a trade goes south and you need to cut losses instead of revenge trading. Okay, once you've audited yourself, you've got to audit the environment. You have to honestly assess the fundamental news calendar. Use sites like Forex Factory or investing.com. You need to know if the market is running hot or if it's just choppy garbage before risking a single dollar. Think about it. If a massive Federal Reserve announcement is an hour away, your perfect technical setup could get totally wrecked by a fundamental whipsaw. You have to validate that the environment actually aligns with your strategy. Moving right along to phase 2, technical entry criteria, or as I like to call it, building the A-plus setup. This phase is absolutely crucial. It builds a physical gate between your intention and your execution. It forces you to slow down so your rational brain can verify every element is there before your emotional brain clicks buy. To get a 100% trade score, you need layers of confluence. First up, higher time frame alignment. If you're on the 4-hour chart, is the daily trend backing you up? You should only be buying in an uptrend, like above the 200-day moving average. Next, check relative strength. Use a rate of change indicator to make sure you're buying the strongest assets and selling the weakest. Then, we wait for our specific triggers: a liquidity sweep, a clear break of structure, and finally, using a 71% Fibonacci retracement for the entry. Now, why wait for the fake out? Well, a liquidity sweep acts as a trap. When the market spikes just above a recent high and then immediately reverses, it takes out the stop losses of early sellers and tricks early buyers into jumping in. That trapped money is literally the fuel that powers the real institutional move in the direction we actually want to trade. Right after that sweep, we want to see a sudden, aggressive shift in momentum. We need a strong break of structure that leaves behind an imbalance, a gap in the price. Price acts exactly like a magnet to these imbalances. It hates a vacuum, so it gets pulled right back to fill that gap. And that, my friends, is exactly where we set our 71% Fibonacci trigger. It gives us an incredibly high-quality risk-to-reward ratio. Now, let's be real. Not every setup is going to be flawless. While beginners should absolutely demand 100% A-plus setups, experienced traders might occasionally take a 75% score. Maybe a non-negotiable step like higher timeframe alignment is missing, but they know the probability is lower. The checklist isn't there to forbid you from trading. It's there to force you to be fully conscious of your actions. But hear this. If you do take a compromised setup, your position size and your risk must automatically be reduced to reflect that. All right, let's get into Phase 3 risk management and execution rules. A strategy just isn't complete until you know exactly how much you're going to risk. You could have the greatest technical entries on the planet, but without strict, checklist-driven risk parameters, one moment of emotional weakness can wipe out a month of gains. The cold, hard reality of long-term profitability is this. You are way better off gathering consistent, fixed-risk base hits rather than swinging for home runs. Keep your risk to something your account can handle, like 1 or 2% per trade. The emotional brain always wants the home run, but the rational checklist demands those steady base hits. To combat shiny ball syndrome and the urge to overtrade, you need to strictly limit your volume. For smaller accounts, maybe that's just 1 trade a day or 3 a week. Overtrading is a classic ineptitude error, right? You take a loss, you get mad, and you force another trade just to win it back. By capping your daily trades on your checklist, you create a hard stop. It prevents your emotions from draining your account on a wild, volatile afternoon. And here is a philosophy you have to internalize. The best trade is often no trade at all. Are you actually willing to sit on your hands if nothing fits your criteria? Your checklist is going to tell you no a lot. It's supposed to filter out the mediocre junk. If your scores are low across the board, the single most profitable thing you can do that day is close your laptop and walk away. Once you're in the trade, your management roles take over. It's a set and forget approach. Leave it alone. You should only move your stop loss to break even if you're sacking or compounding multiple positions, just to protect your total capital risk. Constantly dragging your stop to break even too early because you're scared, that usually just chokes out a perfectly good trade. Let your edge play out. Which brings us to the final phase, Phase 4, the post-trade review, also known as your daily report card. The learning doesn't stop just because the trade closed. You have to journal the process, not just the profit. Sure, track your lot size and your pips, but you need to focus entirely on your execution grade. It is incredibly insightful to grade yourself on how strictly you follow that checklist. Did you wait for the retracement? Did you check the news? If you followed every single rule perfectly and still hit your stop loss, guess what? That is still an A grade for execution. The crucial takeaway here is that a perfectly executed loss is a good trade. And a sloppy, impulsive win? That's a terrible trade. A sloppy win is dangerous because it reinforces bad habits. It teaches your brain that you can skip the checklist and still get paid. Trust me, the market will severely punish that behavior eventually. You have to separate your emotional reaction to the money from the objective quality of your execution. Keep those ineptitude errors at 0. To really cement this discipline, you need physical cues. Anchor your mindset by printing out your absolute best, high-quality chart patterns. Pin them right next to your computer monitor as a constant visual baseline. When you feel the urge to take a subpar trade, just glance at those printouts. If the live chart doesn't match your A+ reference, you don't trade. It really is that simple. Okay, let's wrap this up with our conclusion, the power of the system. We've built the framework, so let's talk philosophy. The market does not reward raw intelligence. It rewards correct behavior consistently applied. By enforcing this checklist, you aren't admitting weakness. You are operating at the highest level of professionalism, exactly like an ICU surgeon or a commercial pilot. Amateurs rely on memory and guesswork. They try to feel out the market, which always leads to those ineptitude errors. Professionals know human cognition is flawed, so they build external systems to safeguard their performance. Keep this in mind when you sit down at your trading desk tomorrow. The checklist is not a crutch. It is armor. Build your list, stick strictly to the rules, and let the system catch you in those inevitable moments when your biology fails you. When you're tired, stressed, or overwhelmed by sudden volatility, your checklist is the armor that protects your account from your own worst impulses. So I'll leave you with this provocative thought to challenge how you approach your charts from now on. Will you let the system protect you, or will you choose to remain your own worst enemy? The knowledge is already in your head. Now it's time to build the system that guarantees you actually use it. Thanks for joining me on this explainer, and I highly encourage you to go draft your personal checklist today.